You're tuned in to this week's Mortgage Minute, brought to you by Mortgage Power Network. Hi, I'm Chip Cummings, and welcome to this week's Mortgage Minute with news you can use. Well, according to Freddie Mac, interest rates slipped a little bit again this week. The 30 years down, actually 0.03 down to 5.98. The 15-year fixed also slipped a little bit down to 5.55%, but the ARMs were up slightly. So if you're keeping track, the 5-1 ARM actually popped up to 5.61%, while the 1-year ARM snuck up to 5.24%. Well, in the news, we've had a lot going on this week. We noticed that Nat City got their hands caught in the cookie jar. That's right, Nat City, National City Bank, got caught by FHA, and HUD fined them $4.6 million for actually insuring loans that had first-month delinquencies. That's a no-no. They were also caught sending in loans late, some as late as 60 days. If you do FHA, you want to get those things in as quickly as possible. Otherwise, it could be rather costly. Well, in a move that's sure to be echoed by other lenders from around the industry, Wells Fargo announced this week that they're tightening down on their requirements. They're going to now require higher credit scores, and they will not be doing any cash-out refinances for loans over 80% loan-to-value, further diminishing the type of loan products that we're going to be able to offer our clients. Don't worry, a lot of lenders are going to creep in and offer some competing products, but for now, that's going to be a trend, and it's going to be very difficult to use your home as an ATM machine anymore. Well, just as we were getting used to seeing some of the higher loan limits take effect in communities in California and Florida and other areas of the country, the Senate Banking Committee has now chimed in with their version of relief. And it includes taking the loan limits from the $729,000 down to $550,000, but making them permanent. While that may be a short-term solution, I don't know if it's going to help some of those communities that are strapped in some of the higher cost areas. In other news, we also have Freddie Mac announcing that they're going to follow Fannie Mae's lead in eliminating a requirement that was going to mandate higher down payments. They now will not take a look at declining markets, mandate the 5% down. Fannie Mae, of course, eliminated that provision just a week ago. We also have problems, though, with some of those loans, as companies such as MGIC have decided not to insure some of those higher loan amounts. And as a result, or the LTVs rather, and as a result, even though Fannie Mae and Freddie Mac may go ahead and authorize that, we can't get loan insurance on those loans. And finally, to round things out, there was a little bit of good news, bad news situation this week, as we saw that new home sales actually snuck up 3.3%. But that, coupled with a price decline of about 14% nationwide, had mixed reactions on the market. Here's what to look for in your business. Yes, there are some more sales, but the values are down. Now is the best time for first-time home buyers to be out there scouting the market. There is a new book that I've got coming out in August called Foreclosure Myths that will talk about how investors can take advantage of this marketplace. So look for that. Until next week, I'm Chip Cummings wishing you well on the road to success, and I'm out of here.